Testing, testing. 1, 2, 3. All right. Here we are again this morning. Very excited to be here. Markets are getting ready to run. We have, today is Wednesday. No, today is Tuesday. Today's Tuesday. We have one more day tomorrow, Wednesday, and then we're off for the holidays, right? Thursday and Friday, we don't come and teach, and so today is Tuesday. As Matt pointed out yesterday, things might be a little bit slow because it is a holiday week, but nonetheless, we want to see if there's not some opportunities to take a little bit of a position in here. Up in the upper left-hand corner, we're looking at the S&P 500. This is in the futures market. All right, up in the upper right-hand corner, we're looking at the Dow. Bottom right-hand corner, we're looking at the NASDAQ, and in the bottom left-hand corner, we're looking at the Russell. So these are our four indexes in the Chicago Mercantile Exchange. Okay, so we are trading out of Chicago where there are no pattern day trading rules. So we can open an account with a very small amount of money. Usually we, recommend people don't try to start with less than 5,000. But if you're going to trade the micro minis, which are 10 times smaller than the ones we're looking at, then you can even open your account with less than $5,000 to get started, 2,500 if that's what you want to do. But nonetheless, we are in the futures market. Different rules, different exchange, different software. You do need to have different software that connects to the Chicago exchanges. It's called futures software, futures trading platforms. And of course, the platform I'm using is, what is the platform I'm using? I'm using Track and Trade. This is Track and Trade Live. Thought I had a little slide there for you to show you, but it's not up on my screen. So Track and Trade is the software I use. It helps me connect to the futures exchange. I also have the stocks version. And we have the stocks version, and here it is. I have the stocks version. People have been having a hard time seeing the stocks version, so I've got it in a different color. This one here is white, whereas our futures one is still black, unless everyone tells me I need to change my futures one too, because they can't see it either, because broadcasting over YouTube, things get a little small sometimes, and it's hard to see when you get a little bit more contrast. So we've got different colors up for YouTube. You can choose which color you like best, whether you like the white color or whether you like the black color. Either way, we know the difference now. The stock market out of Chicago. This is the stock market out of Chicago. Listen to me. I need some tea already. Market opens in 1 minute here. What have we got? 28 and 11 seconds. So we've actually got 1 minute. So what we look for is we look for these markets to all take off and go at the same time. And what's happening is all the orders from the overnight, people who've placed orders overnight need to get filled. And so they get filled on the open. And so that's why the market goes a little bit crazy. I call it like the horses running out of the gate. So we open the gate and let the ponies run. And that's what we're looking for now. For those of you who don't know who I am, why I'm here, my name is Lan Turner. I'm a former instructor at the Chicago Mercantile Exchange and the Board of Trades Education Center, and I'm a current instructor at Utah Tech University. And this is a lab class for my Utah Tech University students. And so we teach our class at night, and we have night classes that we teach. And then, of course, markets are closed. So I would like to be able to come and show people how to do the things that we talk about in class. So we get up in the morning and we watch the markets open. That's a lot of fun. See if we can do a little day trading or a little scalping. First thing in the morning, we talk about recurring price patterns and trends and fun things like that. And then we jump over, and we're going to jump over into the stock market. And there's the opening bell. Look at the markets go. So remember, this is just a whole bunch of orders being filled right out of the gate from whoever placed them in the middle of the night, waiting for the opening bell to go, and then all the big clearing firms come in and start filling all those orders. And so what we do is we generally see them fill all the open orders or all the closed order, all the longs, all the shorts, all the longs, all the shorts, and they just continue to fill them as they can. That's what causes the market to kind of jump all over the place. And does it turn into a trend? Sometimes. Sometimes it'll turn into a trend and you can just ride that trend up. Sometimes, more likely, it just kind of whip back and forth until it kind of gets a decisive direction. What happens is if in the middle of the night, a lot of people, felt like the market was going to go up, there's more buy orders coming through. Of course, there's always got to be somebody that sells them. For every buy, there's a sell. And so that'll oftentimes cause a market to start to trend right out of the gate. You have to wait and see. Usually it just kind of flips all over the place and it's very difficult to know what to do. So mostly we just sit on our hands and watch. And then it'll kind of catch and it'll kind of like, after the first 5 or 10 minutes of watching these markets bounce all over the place, it'll start to trend. And then that's where we can come in and start looking to see if the market's going to continue in the trend and see if there's not an opportunity for us. So we just like to watch them right out of the gate. Looks like they're kind of being a little bit slow. Look at the Dow. It's not moving much anymore. It's already started to slow down. The Russell's trying to go long. Now the Russell, if we go and look, I want to show you just real quick. Down, the NASDAQ's flushing good here. We'll see if it doesn't just come down. It came down and touched that 15,980, just right on the number. And now it started to pull back a little bit. We'll see if it can hold that line. The Russell looks like it wants to go. I want to come in and show you just a little bit longer charts. We can come into 15-minute charts. These are 15-minute charts. And a lot of people trade different time frames. I like to watch the 1 minute because it's exciting to watch those price bars go, but it's a common place for scalpers to be. And, maybe you don't want to be a scalper. You want to be a little bit more longer term trading chart. So this is a 15-minute chart where each price bar represents the movement for 15 minutes, right? So you won't get a new price bar for 15 minutes. So that's okay. It slows your trading down. You don't trade as often. It takes bigger risk because you're going to hold your stop back, behind one price bar back or behind the low of the trend to get in. So it usually takes a little bit bigger risk to go in, but you have a little bit more stability. So you have to kind of decide between stability and risk and where you want to be. So that's what we're looking at here. We're seeing that we're down and mostly for the last 15 minutes, these 15-minute bars in these last overnight, since midnight, it looks like 9 p.m. was yesterday evening. The S&P's been an overall downtrend. The Russell overall downtrend. We got the NASDAQ and an overall downtrend, and we got the Dow and an overall downtrend. So everything's kind of been losing its steam here on the 15-minute chart on the longer term time frame. So that's a good way of coming in and saying, well, I guess for the most part, we're kind of feeling bearish on this market today, feeling a little bit bearish. So there could be a rebound. It could come back, but to give us a little bit of an idea, let's pull this S&P full screen. That was the big rally that we had yesterday. Again, this is the 15-minute chart. So you can see we had the big rally. Then the market just kind of died and went sideways. And of course, that's going into the afternoon, evening session. Now, remember, the S&P here on the futures market doesn't close. It closes for 1 hour around 3 o'clock. And so right in here somewhere it closed, and then it just opened right back up again. And then that's how that works. So it just closes for an hour and then opens right back up. It trades 23 hours a day. Not true over in the stock market. If you were trading the S&P or SPY would be the ETF you'd trade to trade this market. It does close. It closes and then you're done. You're done for the day and you don't do any more trading. Not true in the futures market. So that's why you'll have gaps on your stock market charts, is because the futures market is still trading. And then in the morning, you wake up and there's a big gap and you're like, what the heck? Who was trading in the middle of the night? Well, we were over here in the futures market. So that's what happens. So here this market's coming back. If we draw a Fibonacci ruler on this 15-minute chart, you can see that we're bouncing right back down here into the Fibonacci sweet spot. So we're going to come down here and decide what we want to do going into the holiday. And we'll have to wait and see if it wants to turn and rebound. But we can look at this. This is a drive 1 down. This is the long counter trend. This is drive 2 down, long little counter trend, and we're in drive 3 down. So that's 3 drives down coming off of that rebound, bringing us right back into the Fibonacci sweet spot. If you're not familiar with how to count this, and you're like, what the heck is he talking about? 3 drives down? This is an Elliott wave pattern. You can pick this up in my book. It's on Amazon. This is the manual to the class. which if you're in the class at Dixie State University, you can, Dixie State, here I am calling it Dixie. We just changed the name of the university from Dixie State University to Utah Tech University. And if you're in the class at Utah Tech, then you have this book. It's in your portal. It's a PDF. If you'd like the paper version, you can go get the paper version out on Amazon, lanhturner.com. Just lanhturner.com. Just search Lan H. Turner on Amazon, and this will pop up, and you can pick up the manual to this class. All right. So we are learning how to trade, and that's what we're kind of concentrating on, spending a lot of our time on the technical analysis side of trading. It's not that we only look at the technicals. We do look at the fundamentals. The fundamental nature of the market is what's telling us the long-term trends, right? We kind of look for the fundamentals to tell us which direction the market's going to move, but then we use the technicals, the mathematical models, to tell us when to get into these fundamental trends. So we believe both are important. You got to have both fundamentals and technicals working together. And with that, let's look at today's news. This is the economic calendar. And today at 6:30, we had Chicago Fed National Activity Index. At 8 a.m. today, existing home sales. So in 20 minutes, we're going to look at existing home sales. That'll move the market a little bit. Usually the existing home sales moves the market. So we're looking at, the previous was 3.96. The consensus is 3.9. Forecast is 3.91. So existing home sales is going to go down according to the forecast. We'll have to wait and see and decide whether that makes the market go up or down. Existing home sales month over month that is coming in. Previous was down 2. Forecast is down 1.3. So they're expecting better numbers. FOMC minutes are coming in at 12 o'clock noon, and that's a red. So that's going to move the market. That's going to make the market jump and run. And so around 12 o'clock, we're going to want to watch that market. Now, I don't generally want to trade the market bang right at 12 o'clock when it starts flipping all over the place. I like to wait until it decides which direction the news that they present to us is, good or bad, and then the market will have a tendency to trend in that direction. And so we don't want to trade exactly at 12 o'clock. We want to wait till it kind of calms down and picks a direction, and then that's the direction we want to take. And then, of course, 2:30, the crude oil is coming in. So that's our news for today. Tomorrow, 6:30 a.m., durable goods comes in, so we should have an active morning at 6:30, an hour before the market opens in New York. But, of course, we can trade that in Chicago. So durable goods coming in at 6:30 a.m. That's going to move the market tomorrow. We got some other stuff that's going to move the market, but we'll be here. We'll be here to watch oil. It's a lot of it's at 6:30 in the morning. And then 8 a.m., Michigan Consumer Reports, Michigan Consumer Sentimental. They often have that as red, and I think it's good they downgraded it. It doesn't move the market as much as they think it does. All right, so the market's still continuing to fall. You can see here on the 15-minute chart, it's dropping a little bit lower. I do want to say we're going to be going over and reviewing the options today, and I have a really important lesson for you. It's called Black and Scholes, and we're going to learn a little bit about Black and Scholes. Super important when it comes to options, and you're going to learn why that's so important. And that's what we're going to be doing today after we get done looking at the day trading stuff. Let's look over here. Come back to the 1-minute charts. Let's come over and say hello to people. See who's in the house. We got Matt. Matt, it's good to see you. Glad you could make it. Are you in the market yet, Matt? I've been talking about other things. Haven't been watching. Oh my goodness, Russell crushed it to the downside. Look at S&P. Ooh, that's ugly. Look at that S&P right out of the gate. Nothing. That's a bad sign. Completely flat. See if it wants to break one direction or the other. Look at the Dow. The Dow followed. Look at the NASDAQ wants to run. NASDAQ wants to go along with the S&P. You can see it in there. It wants to go. But it's being pulled down by that Dow. Dow's pulling down. Russell's pulling down. So we got Bruce. Good morning, everyone. Bruce is saying hello. We got G Wiz. Great to have you, G Wiz. We got John David Lundberg, top of the morning. And we got Steve Scott. Great to see you, Steve. Glad you could make it. John Mackey. Good to see you, John. It's always good to see our Canadian friend, Gary Thomas. Glad to see you, Gary. We've got Michael Bruce in the house. It's good to see you, Michael. And then we got Matt says, I got in long on the R2I to start, so working out of a hole right now, currently short. Well, happens to all of us. Have to work ourselves out of a hole. There's Larry coming in saying good morning. It's nice to see you, Larry. We got a lot more people in the room. I can see we got quite a few more people watching other than what said hello. If you guys want to throw up your little hellos, I'll make you famous. Put your little tile up there. It's nice to see everybody. Glad you could all make it. Matt was thinking maybe we're going to get a breakout to the long side. Right here, it looks like, on these green bars, I would assume. And then they failed on him. Market short right now. Got a little bit of a flag formation in there, looking like it wants to try and break one more time. It did not break the green lights on the reversal. I got those green lights set at 1 and 1. It's like it wants to try and go up there and break those green lights, so Matt. We'll see. Got that little flag formation forming right now. See if we get an ABC. Usually here in the morning we don't get the ABCs. We get the little snaky pattern, right? Yeah, one up for every down. A, B, C, D, E, F. We're going to go up. Looks like it wants to go up. And then is it going to turn and go down again? Or is it going to continue to come up and break the previous high? Wait and see. All right, look at the NASDAQ. Man, live. This is our holiday. This is our holiday morning session. We're kind of struggling here. We've had a couple. I mean, the Dow moved good, and the Russell moved down good, but it's kind of hesitating right here. Can't decide whether it just wants to turn around and go bullish again, or if it's going to turn and fall and make an ABC to the downside. Let's watch this a little bit here. We got B. Taylor saying hello. How you doing, B. Taylor? Glad to have you. Kirk Schwartz. Good morning, folks. Glad you guys could make it to class. We're going to be talking about Black and Scholes today. And then I do have a Sunday school lesson prepared for you, so stick around for that. All right, here we go. The Dow's getting a little bit of a rebound here as well. This is a decision point. This is what we call decision point trading. All right, you're waiting for the decision to become market to get into a decision, and this is our decision point. Is it going to continue to rally, or is it going to turn and give us that A, B, C to the downside? A, B, C, one up for every down, right? And we're looking for that. We just don't know how big the ups are going to be, and we don't know how big the downs are going to be. Now, this is a red arrow. Remember, we talked about that yesterday. We got a red arrow indicating that we're in a downtrend. So do we take the yellow arrow? No. We don't take the yellow arrow to the upside because it's going against the trend of the red down arrow. This is a dual arrow right here. So you get two in a row. You get to take this position when they're right on top of each other like that. Of course, right there out of the gate, we got a flip-flop. That's the little flip-flop. So you got two arrows right there. And then we got the up arrow. We don't take that one because we're still in a downtrend. So remember, the red arrow. My goodness, hold on a second. I got to drink some tea. The red arrow tells us that the trend direction. The yellow arrow does not tell us the trend direction. The red arrow tells us the trend direction. The yellow arrow gives us the entry, okay? And all it's doing is it's telling us when we're crossing that average true range. Now, on the Dow, I've got the average true range pulled in a little bit tight, 0.08. Up here on the Russell, I've got it at 1.1. The NASDAQ, I've got it at 0.8. And the S&P, I've got it at 0.8. So my Russell is a little bit looser than my other markets. But we're getting the down arrow. If it breaks those green dots, then that's going to be the mathematical model to the downside break, and that'll give us an arrow to the downside. Now, this is where you come in with what I call the spider web. All right, so let's put a spider web in here. The spider web is your speed fan. All right, so you get your natural trend line, you get your mathematical trend line, and you get your horizontal break on these little ABC patterns. Anytime you get a little ABC pattern like this, we're looking for the market to pull back, rally, and then drop again. And those are the three locations for entry. You can take the natural trend line break, which is, you're going to see it. It's the natural trend line. That's the little flag formation. When it breaks that, you can take that. That's your early entry. Your mathematical model comes in usually halfway between let's blow this up a little bit so you can see a little better. Woo, that's a little crazy. The mathematical model, and let's go in there and set that ATR. Let's make it a little more aggressive. Oh, that's not aggressive. 0.8. So the mathematical model comes in, and it's a little bit more, there's your natural trend line. It's about halfway between the low, which is the horizontal line, breaking below the previous low. That's your second entry if you would like to take that one. And then you have the horizontal line, which is the breaking the previous low. So those are your three locations in an ABC pattern to the downside where you can enter this market. And you can enter all three if you would like. So that would be the game, right? You're looking for the ABC pattern. You're looking for a market that's proving that it's moving down, pulls back like this, and then you're looking for the ABC. And then the arrow, this is a red arrow saying that we're in a downtrend. This is the little arrow indicating that we're moving down. We don't take the reversal arrow because we still have a red arrow. So this is your ABC pattern. All right. This is classic right out of the book. So we have three locations for entry on an ABC. Again, natural trend line, mathematical breaking of the trend line, or the horizontal trend line. You can take 1, 2, or 3, or you can take all three. Depends on how aggressive you want to get and how much you believe this market's going to move. So there's that one. Let's come in and take a look at what's going on over here. We're getting the same kind of basic pattern over here on the Dow. So we got the natural trend line. If we come in with our 1, there's the 2, and then the horizontal. Now, it doesn't mean the market has to fall. Certainly does not mean that at all. It did over there on the Russell. Beautiful trade on the Russell. Did I say hello to you guys coming in here? We got Barrett. Did I say hello to you, B. Taylor? Good morning, B. Taylor. We got Kirk Schwartz saying good morning. We got Ben Corpus. Good morning, guys. Glad you could be here. And then we got in here. What do we got going here? This Dow is not following through like the Russell did. So we're going to watch these markets. Watch and wait. Watch and wait. Should have taken a position on the Russell with Matt. Should have taken a short in there on that little ABC pattern, that C pullback. We'll watch. We'll see. See if there's not something. It's pretty slow right now. The Russell's doing good, though. Russell, can't complain about the Russell. That's a nice pattern in there. Beautiful ABC. It's coming down, approaching the 100% projection level right now. What is that 100% projection? Well, that's an equal distance in price. And if it touches it right on the line and time. So from A to B, and then you have your pullback, and then your A to B movement, right, would be from C to D would be right to the 100% level. And that's how we calculate that. And the distance or the time is, look at that, it's coming right down right on that thing like a train on rails. So it's the same volatility scale. And if I grab that A and this A would have come over here, it's going to move that B leg. If it would have been a little tighter, it would have come in here. But if you put it in here, it's the same volatility. So it fell from A to B, and then we anticipate the pullback, and then from C to D to be a repeat, what we call a mirror of A to B. All right, that's your mirror image. So we anticipate it to be the exact same thing. Just repeat that A, B, C, D. It's coming down, touching that 100% level. Just almost exactly like a train on rails. That's a perfect setup. Just right. Classic. I should take a picture of that one and put it in the manual. That's how perfect that one is. Matt, I hope you're capitalizing on this one because this one is just like you couldn't. That's like an engineering move right there. That is a perfect move right to the 100%, right on the timeline. Wow. So here we're coming down. 130.9 is actually the Fibonacci sweet spot for the projection level. It's actually your Fibonacci golden ratio, 130.9 to the downside. We got 61.8 is the golden ratio to the upside. 130.9 is your golden ratio to the downside. Or retracement. Either one, they can be up or down. Not the up or down that's important. It's the fact that one's a projection, one's a retracement. Look at the Dow. The Dow did not follow through with our ABC pattern to the downside. A, B, it came up, and it failed that ABC to the downside right there. And now it's trying to make another pullback. We'll see if it'll come up. It's at 61.6 right now. Look at that, 61.6. So that's our golden ratio right there to the reversal side. Now we'll see if it bounces off that and if it comes down and tries to come down and create a 100%. Not gonna see break right there on those magic green lines. That's your natural trend line coming in right there. Now that first one was just a rebound. We thought it was going to drop. It failed. Didn't break through the green dots. Coming up 61.8, 61.6 is where it's sitting right now. 61.6. So that's your Fibonacci. If you put your Fibonacci ruler in there, let's put our Fibonacci ruler in there. Bring this up so you can see it a little better. Go from the top right here at the A point all the way down to the B point, drag it across, and you can see that that's come right back into the Fibonacci sweet spot. So both those tools measure basically the same thing. So it's just a different way of looking at the same numbers. It's just a ruler, and we're just measuring how far back this market's coming. This is what I call the Fibonacci sweet spot between 61.8 and 38.2. So that's the sweet spot. Comes down, comes back to the sweet spot, and then usually we'll anticipate a drop out of the bottom here and then down to 100 or 130.9. Does it always do that? No, of course not. It can do whatever it wants. Or it can even just kind of wander sideways after that. Oftentimes the market will just come in, show weakness, and start to just do one of these things. And then if you try to trade it, that's where you die a horrible death. So we need it to move. We want to see it break. If we're going to take a short position, we can anticipate a short right here based off of the fact that we're on the 61.8, looking for it to continue to fall. So we come in here. We'll just take a quick short out of here just in case that market wants to fall. We could take a second short if it breaks the green dots, so we could put one on there. We'll just drag one onto the green dots. And then the natural trend line is right here. So this is all based on Fibonacci. We're saying, well, look, we hit 61.8. We're going to look and see if we want to drop farther. Drop and come back down out of the 61.8. Doesn't mean it has to. We got that 78.6 up there. It could turn and go back up to 78.6. And then once it does that, then you start to cry because that 100% is just staring at it, and then it likes to go up and break that 100% and continue to rally. Okay, we've taken a second short position, so we're in the market with 2 based on Fibonacci retracement here and crossing the green dots. So we've crossed the green dots. We broke them. We didn't close below them. We needed to close below them. We have our short position here, trying to take a short in anticipation of a continuation of the downtrend. So one of these has a stop on it. So we have a trailing stop. It's 1 price bar back. I'm going to come in here and I'm just going to tell it to stay right there for a minute. Don't want to get too aggressive on my trailing stop. And we just want it to continue to fall. Now what oftentimes happens is this will turn, come down, it'll fall a couple bars, test that green dot, maybe not even break or hold below it, turn around and start going right back up right here. If it does, we'll just get stopped out with a small loss. But for us, we want this thing to continue down, right down that scale line all the way to 130.9. We're going to have it's not going to go straight down, although it did this morning, but that was the morning bell where we want to see it continue to go. We just don't want it to turn and start to rally right here and give us a ABC top formation or a 1, 2, 3 top formation. We want this thing just to continue to push lower. We got our second contract in there. So we're short with 2. We could scalp one out right now just at that 38.2 just to take some profits. It's called the scalping trail. But I'm going to watch the little chart in the upper right-hand corner. That's our tape. right? We talked about the tape. So that's a little chart. We're charting the tape. If I see it start to rebound hard against me, I'll get out. But as long as it wants to push lower, watch that little tape. As soon as you start seeing green on the tape, as soon as it starts to rally, we'll take one off. But if it wants to continue to push down, we'll stay on there. Let's go a little sideways now. Little sideways. Push again. Push again. No, we're going to take one off right there. All right, so now we're just short one contract. We took some off. So that's called the scalp and trail strategy, where we scalp one out, covers our losses. So now if the market comes back and stops us out with a loss, it's not a complete loss. We're not going red. We're just scratch trade. All right. So scalp and trail. So if we get in with a couple, then we can let the other one trail for as long as it wants to trail. So what we're going to do now is we'll just come in here, and those little green dots, you'll notice how well it travels down behind the market. We'll just come in here and we'll go edit, and we'll say trail on the little green dots. And there we go. Now it'll automatically pull that stop in. All the decisions have been made for us. If it comes down and tests this 100%, we'll take the next one off. Actually, our goal is $500 a day, right? So we're at 80, so we need to have $420. We could, oh, that's a long ways down there. 420. Let's clear down at 130.9. We'll see if it can get down there. Probably not. It's going to take us more than one trade to get to $500 trading the Dow. Let's get rid of this Fibonacci thing. Let's get rid of this circle here. Let's get rid of some of these drawings. Clean this market up a little bit so we can see. We got our Fibonacci projection line in there. You see the market starting to wimp out on us. You see that little tiny chart in the upper right-hand corner. So Ben Corpus says, hello, good morning, Ben. It's nice to see you. All right. Let's just see if this market doesn't want to drop. Okay, our stop's been pulled into profitable territory. Now, at this point, if we wanted to, if we're like, well, you know what, I think this market's got a lot of downside potential, don't be so aggressive with your stop. We could turn the stop off right now and let this market move out a little bit farther, or we could be, it just jumped in, so we'll let it jump in. But we could stop at break even and let this market wander a little bit, just in case it wants to do a little, we don't stop out just as it turns and starts to run. But we just got stopped out, so we'll have to wait and see if it wants to turn and fall once again. Of course, it could be making a little ABC to the upside, right? Whenever you can see that there's a downside potential, there's also upside potential. So to the downside, where would our spider web go? Natural trend line, mathematical trend line, horizontal trend line. So there's your spider web to the upside. So I don't really want to take a long position because, again, oh, wait, we do have a red arrow. We switched to bullish. So I went against it when we took that short position. That's a counter trend to the downside. That means we should be looking to the upside here. Do I want to go long right now? Not really. Although it's holding above, so it's making a 1, 2, 3 ABC pattern. If it holds above that green dot, that would be bullish. We're in an uptrend. I think it's going to fail, though. I think we're going to get a little failure, and I think it's going to come back down. Should we see if my intuition is correct? Put my money where my mouth is. Nope, my intuition was incorrect. The indicators were more correct than me. It's still trying to rally. So we'll take that off. It looks like it wants to go back up. It's going to go up and give us a W bottom, one of these things. 1, 2, 3, 4, back up, tie off that little, that's a butterfly pattern right there. So if it goes back up, it's going to go all the way back up to that blue line, and that would tie off the little butterfly pattern. Let's kill all this information here. And we're going to go. Of course, it doesn't have to do anything. It could just sit here and wander sideways and not trend at all. There it goes. It broke the green dots. So we'll put our spider web back in there. Boom, boom, boom. Lan, why are you trading the Dow? You hate the Dow. No, I love the Dow. You hate the Dow. I thought you hated the Dow. No, I love the Dow. Look at the Russell. I hate the Russell. Why do you hate the Russell? We all love the Russell. I hate the Russell because it always makes me look like a fool because I didn't take the trades and they're so obvious. I always leave this one to you guys. One up for every down. So we're in a red trend. Take the arrow. Take the arrow. Why are we not switched to bullish yet? Take the short arrow. That one failed. Look at the Dow. It's wimped out on us. So it's not doing anything. It's not going short or long. The NASDAQ is horrible. Look at that thing. Holy cow. This is the holiday weekend. Look at the market, isn't it? What a nasty market this has been. That Russell. I hate the Russell. I should be trading the Russell over there with Matt. You always go trade that Dow. There we go. Look at that Russell. Let's go bring that full screen. Watch the Russell. Where's our Fibonacci ruler? We go from the top to the bottom. And that market's right back there, dead center of the Fibonacci sweet spot, right between 61.8 and 38.2, touching that 50% retracement on the major move. So we got a first drive down this morning. We got drive 1. We got the counter trend. We got drive 2. We got the counter trend. And it failed to make drive 3. So drive 3 should have come down and broke this low right here, and it didn't do it. So it gave it a little ABC pattern to the upside, broke above here, and that's a confirmation the market is no longer bearish. It's now bullish because we now have higher highs and higher lows as opposed to lower highs and lower lows. So that's your reversal. Okay. That is your little 1, 2, 3 ABC bottom formation. Or if you go back one line, it'd be your head and shoulders. So left shoulder, neckline, that's your head, that's your neckline, that's your right shoulder right there. And that natural trend line, let's get rid of all this stuff. Make it easier to see. Get rid of all these little blue lines. And there's your head and shoulders natural trend line. Okay, so that natural trend line, come in here and bring that all the way back. Notice how that thing came down. Left shoulder, man alive, this thing is just like a train on rails today. It is trading every pattern as if it was mathematically calculated, pre-scheduled. So there's your neckline of your head and shoulders formation. It's turned, broke right there. That's your neckline break. This is your horizontal break, confirming that we are now in an uptrend, higher highs and higher lows. Man, that thing's going up like a train on rails. We're going to anticipate that it's going to come up and test that blue line or that 1800 point. It's not going to go straight up, though. I think we're going to get a little A, B, C pattern in here. Probably get a little A, B. We'll get a little pullback, test this low. Got to make that little Fibonacci bow tie. Might not happen. Might just keep trucking right on up. We'll just keep adjusting. That would be a little butterfly pattern too, wouldn't it? Come in here, this little butterfly. And then that'd come shooting all the way back up here somewhere. And then back to the C point, back up here and tie off your butterfly. It's our little butterfly wing in there. Natural trend line. See, it's kind of breaking here, giving us a little flag. See if it breaks those green dots right there. Stochastics is way up in the overbought region. We're on the back side of the MACD. MACD switched right here. See the green from red to green? That's the back side now to the down, meaning that we're going bullish. So it did. It curled and started to follow along. Well, what we're going to look for here is we're going to see if it's going to break that green dot or not. Okay, it broke it. Now is it going to close below it? Got 2 seconds, 1 second. No, it did not close below it. So it didn't throw the arrow. If it hangs above it, that's what we really like to see. We like to see this thing turn and rally and go back up once again. So if it does, we could put an order in there on a break above that previous bar. Okay, we're long in anticipation of this market making an ABC pattern and come up and test that blue light. So this is a decision point. If it fails and comes back down and breaks that green dot, we have to get out, take a small loss. That'd probably take away everything we've made. We only made $65. We did a scalp and trail, and the scalp and trail worked barely. Then we had one more try. I was just going to check and see if this thing was going to continue to fall off of here and go down at this point, and it did not. That's where it curled and turned and went back up. I thought we were going to make 3 drives down, and it didn't make 3 drives down. Now we're checking to see if this little butterfly wing is going to follow through. So it's got the A, B, C. So we're going to have, again, this is drive 1, drive 2, and we're looking for drive 3. Drive 3 is always the toughest one. It's always tough to get that drive 3, and I don't trust it. Get my stop in there on the green dot. If it comes down, touches that green dot, I'm just going to get out. It touched that horizontal line. See that horizontal line in there? It went up there, touched it, and said, no, not breaking through. We're going to go down and take land out, and then we'll break through. Come on, baby. Get a little oomph in there. Push it up through there. If it doesn't push up through there, we're going to... Our green dot came in, but it didn't move. Okay, it tried to break through again. It's trying to break through that horizontal previous high right there. That's what it's trying to push through. We want to see it come up, test that 1800, go up to VWAP. VWAP's like our rubber band. It's trying to pull that market back up to the VWAP. We haven't got a limit order in here. We're just trading with no limit, no profit target. We should get one in there, though, probably. It's way up here, though. And actually, the previous high on there is right here. See that previous high? That's probably a better place to use as our resistance point. So I'm going to bring that down just inside that previous high. Make it easy to hit. Now we just got to wait. We're still in a losing trade. We still haven't the market barely broke above $5, but we wouldn't get out until we had our green dots hit. And the green dots are still behind our entry point. So we're still in a losing trade at this point, because the only way we'd get out is if our green dot was hit. Our green dot is below our entry. Come on, push it up there, push it up there, push it up there. It doesn't want to do it, does it? Be patient, land, be patient. Be patient, little Russell. Come on, little Russell. 2,000 stocks are being bought up right now. Push it up there, little Russell. Stochastics is way up there. That's called the stochastics pop, or the stochastics push, whichever book you read. Sometimes they call it the stochastics push and the stochastics pop, meaning that the market went way up into the overbought region, and then the market continued higher, didn't turn and rebound. There, we're getting a little action. Come on, push it up there, little Russell. Hit the 61.8 projection off of, oh, well, that's not really set right. So that 61.8 projection's in the wrong spot. It's close, but no cigar. Let's put that over here. That's where it belongs. So our order, well, let's put it right down there inside 61.8 just to see if it wants to push up there. Getting a little sad right here. I'm going to move this stop. I don't want to take a loss. I'm going to put it right at break even. If it takes us out, at least won't wimp out on us. Come on, push up there and hit the limit. And then we'll go over and talk about stocks. Come on, we want to talk about stocks. Get up there, you lazy bugger. Yeah, it's not going to go. Come on. That's 4 flat bottom bars. There we go. Now we got to get a 5th flat bottom bar to take that thing out. Come on, lazy Russell. Russell's being lazy. Let's push Russell up in there, right below that Heikenashe low point. We just got stopped out. $80. Whatever. All right. Exit the chart. Let's go over and talk about stocks. We tried. It got a little slow. I got a little anxious. But we're going to go talk about stocks. And the most important thing I can teach you about stocks today, about trading options. All right. I got a little slideshow. For those of you who are in class, you saw this little slideshow. So I'm just going to, not the whole thing. We're not going to go through the whole thing, but we'll kind of touch on the highlights. All right. So what are the Greeks? Hold on one second. Got to have some tea. All right. What are the Greeks? And are they important? So let's come over and talk about the Greeks and ask if they are important. Hopefully you guys are seeing this. All right. Land Turner, 21st century stocks, futures, and forex trader, famous in his own mind for having said the Greeks are not all that important. Not individually, that is, but when combined, they become absolutely imperative. All right? Absolutely imperative. All right, let's talk about what the Greeks are, because you're going to hear this when you're trading. Some guy's going to be on his little YouTube channel. Oh, the gamma's going crazy. Oh, the theta's doing this. Oh, the delta's that. We talked about delta yesterday. Delta is one that's important that you can use individually. Very important to look at individually on delta. Not so much gamma. Theta, that's time decay. That's the impact of time on change. That's how fast your decay of your extrinsic time value, opportunity value is decaying. All right. But it's just one number. It doesn't really mean anything to you. People like to pretend like they know what that means. Oh, gamma's doing this. Oh, gamma's doing that. And they don't know. Bullshit. All these numbers, these are just variables that work together in a individual formula. And I'm going to show you that. We got Vega, which is basically the same thing. Oh, Vega's doing this. You go watch YouTube, guys. I just laugh. Oh, Vega's up. Oh, Vega's down. They don't know what it means. Price change. That's rho. That's an interest rate, because you have interest rates on options, because basically you're borrowing, right? That's what you're doing. So you have an interest rate, and the interest rates are calculated in the options. And a very short option, interest rates aren't going to have much of an effect on it at all, right? So you go and get a very short loan. The interest rate, even if it's 20, 30% on a very short loan, doesn't affect the overall price very much of your loan. But if you get a 20, 30% on a loan that's a long time, then it's a big number. All right. So that's how rho, or price change in percent, affects the time value of your option. But again, if you're just doing short stuff, it doesn't have that big of an effect. So like, oh, rho's doing this, oh, rho's doing that. That doesn't mean bullshit. You got to work all these things together into one big formula that gives you an answer. And that's where it becomes magical and the performance occurs. All right. So let's talk about the implied volatility. And implied volatility is not a Greek, but it's one of the very important variables in the formula that creates this number that we're looking for, and why all this stuff is important. All right. So we're going to look at implied volatility as well. So I lump it into the same category. Now, we're going to also talk about that, because implied volatility, guys can look at implied volatility and they can think that it's important. But for the most part, a single number of any of these numbers doesn't really mean anything to anybody, because this is why. Because you might be looking at implied volatility, or any number, rho or gamma or theta or anything. If you look at one number in isolation, it really means nothing to you, because it could be, for example, it could be 30, right? But 30 for Microsoft is low because it's coming down, and 30 for Apple is high because it's coming up. All right. But if you just have the one number, 30, what good is that? Means absolutely nothing to you. So just having one single number out of this magical formula of the Greeks doesn't mean anything really. Now, delta, it does. Delta, we talked about that yesterday, and that's why I talk about delta at length in its own lesson, because delta is a very important number individually, but the others, for the most part, are not. You don't really use them for anything because they are combined. They're just variables in another mathematical model that we use. Okay, so we need the history of these things. That's why we have the historical volatility that you can look in your software. Track and Trade has it. I would assume most other platforms are going to have the historical volatility, the historical charted implied volatility, so you can see from a historical basis whether 30 is either high or low, whether 30 is coming up and so volatility is increasing, or if 30 is coming down and volatility is decreasing, because volatility also changes the value of your option. And that's why that's important, because you can have a lot of people are like, well, I'm just going to buy options right before earnings. Okay, a lot of people have thought of that. You're not the only one that thought that that was a good idea. So a lot of people do it. And so that causes a lot of volatility and the anticipation of a lot of volatility. And so because of that, the price of the option will explode. It will go up significantly, all right, or down significantly, depending on the biases of the market. And the market didn't move at all, but yet the price of the option exploded. That's because of implied volatility. All right. The volatility of the market can change the option's value without the underlying stock moving at all. So you have to keep that into consideration. You have to take that into consideration. So is volatility coming down? If I tell you volatility is 30, is volatility coming down or is it going up? You don't know. It means nothing to you. All right. So you need to have the historical, or you need to take those variables and put them into a formula where they all work one with the other hyperbolically to give you a mathematical model that can be helpful. All right, so let's come back. Well, that's where I want to go. I'm going to skip this one. We're going to talk about this at another time, about your probabilities. And we talked about delta yesterday. So that's the implied volatility right here. This is where we're at. So this is called the Black and Scholes model. All right, who are Black and Scholes? Black and Scholes are two mathematicians. All right, Fisher Black and Myron Scholes are two economists who won the Nobel Memorial Prize in 1997 for having created an options mathematical pricing model. All right, and that's why we call it the Black and Scholes model, because it's just the guys' names. Now, again, goes back to that thing where in this industry we name stuff. Most of these tools and everything that we do is just named after the guys that either invented it or popularized it, or wrote a book about it. Or a lot of these indicators just written about, Chalkin money flow, for example. Well, the guy that invented it, his last name was Chalkin. That's why a lot of this stuff is just named after people. All right. So that's what the Black and Scholes model is. It's named after Myron Scholes and Fisher Black. So what is the Black and Scholes model? There it is. That's it. So take a picture of it, write it down, because you need to know that for your final exam. Just kidding. You don't need to know that. Why? Because we have computers. Computers know how to use that. Computers know how to calculate that. Now, the problem is that a lot of cheap, worthless trading software, and I'll harp on this for just 1 second, they don't have these formulas in there because they're hard to program. All right. Look at that formula. There's not a lot of computer programmers who know how to write that crap. All right. It's really difficult to get somebody to write that. And so there's a lot of software programs that don't have this information in them. And if you are working with a piece of software and you're trading options and it doesn't have this built into it, throw that piece of crap out and go get a software program that does have it. All right. You got to have it. It's like eating a McDonald's hamburger and not having the French fries and the drink. Who wants to eat a burger without French fries? You just can't do it. It's impossible. All right. So you can't trade options without having the Black and Scholes model. And there's a lot of cheap software out there that doesn't have it. If your software doesn't have the Black and Scholes model, throw it away and go get one that does, or don't trade options. That's your choice. You can stick with your piece of crap free software, but it's not written by somebody who knows how to do that if they don't have it. And okay, I'm done harping on that. Get you some decent software. All right. If you're going to do this kind of thing, it's like, either shit or get off the pot. Don't do it halfway. Don't just cut corners, because this thing is going to make you a lot of money if you do it right. Or if you do it wrong, it's going to cost you a fortune, a lot more than a little piece of software is going to cost you. So it's just, if you're going to do it right. That's all I'm trying to say. Get you the right software, whether it's Track and Trade or another program. I don't care what you use. I mean, we prefer you use the one I use so that I can help you. But if you don't want to use this one, if you got some other software, just make sure it's got the Black and Scholes model in there. The Black and Scholes options pricing model gives a theoretical estimate of the value of an option and shows that the option has a unique price, regardless of the risk of the security and its expected return. That's a real important sentence. What does that formula do for you? The pricing model gives you a theoretical estimate of the value of an option and shows that the option has a unique price, regardless of the risk of the security and its expected return. You know how important that is? You know how important that is to know when you're trading options? All right, let's go to the next slide and give you kind of an example. What that means in layman's terms is it is the Kelley Blue Book of options. You know what a Kelley Blue Book is? Any of you guys ever gone and bought a used car? Okay, and you walk on the lot and they have a sign in the window that says, this car is worth $10,000. And you're like, okay, how do I know that's what it's really worth? Maybe it's not, maybe it's only worth $5,000. Maybe it's worth $20,000. How did they derive that $10,000 number? Well, when it comes to a used car, we have a guide, right? You have the Kelley Blue Book, the used car guide. Now, there's also another one out there called the ADA book. Maybe you're more familiar with the ADA book than the Blue Book. So the ADA book is one that you can open up. It's a little orange book. But the reason those numbers are important is because that's the number that the industry has determined the value of that car. And banks, that's what they loan against, right? They don't care about anything else unless you can justify big numbers for them or big things, but they're going to loan against that number that's in that book. You go to the bank, how much is the car worth? They look in the book. Oh, it's worth $10,000. How much are they asking for it? They're asking $10,000. All right, we'll give you a loan. Okay, so that's how that works. It's the same thing in options. When you buy an option, sometimes they're expensive, $3,000, $4,000. Sometimes they're cheap, $500. Sometimes even cheaper, $75. How much do we pay for that one? That's $79 on that little Apple option, out of the money option, right? $79. But you want to know what it's worth, right? You need to have the Kelley Blue Book that tells you, are you getting it for a bargain or are you paying an expensive price for it? So we can use this number that comes out from the Black and Scholes as a Kelley Blue Book answer to our options. All right. And that's why it's important. You need to know what that option is worth and whether you're paying a premium for it, whether you're paying a discount for it, or whether you're paying exactly what it's worth. And if you don't have that number, how in the heck can you be a used car salesman without a Kelley Blue Book? So that's what we're talking about here. All right. So back to the Black and Scholes, the Greeks. Individually, the Greeks, or individual variables, which we talked about, provide a trader very little in helping to make better trading decisions. If you know what the number is for rho, who cares? It's not going to do anything for you. All right. But when you put them all together in this mathematical model, into this formula, they become imperative when combined together into the Black and Scholes formula. All right. You've got to have them. All right. That's my most important thing in the world that I can teach you about options trading. You got to have that mathematical model. All right. Let's go look at it. Let's go play with it, because that's what's cool, right? Where's a stock that we don't have any TJX? I can't remember why that's up there. What if we, let's look at another stock. Let's go into the thing. See where we don't have any. Netflix. Just go buy some options on Netflix, or at least price some out. Look at Netflix going to the moon, right up here. There's our peak. So what do we think that Netflix is going to do? Now, we're not going to get crazy right now. We're just going to come in and use the Black and Scholes model to price out some options. We're going to come into the options chain. Hopefully you guys can see this because it's on the black and white background. It's not the black software anymore. I've changed that. Bring our window open a little bit more. So there's Netflix. What a crazy market, right? Okay, so what do we want to do? We want to buy an option. Maybe we think that this market's going to turn and fall back down. Maybe it's going to give us a 50% retracement at some point, right? So we're going to come in here. And maybe that's what we're thinking. This market's going to come up. It's going to touch this previous high, maybe up in here somewhere. Maybe that's where it's at. And then it's going to come back down into the Fibonacci sweet spot. So if it does that, we want to have a put option that says we're going to make money as the market falls. Now, we don't know how far it's going to fall. It might fall this far, and then it might turn and go back up again. It might fall this far, hit 38.2 and go back up. It might come down here to 61.8 and go back up. We don't know. It might not even go up, but go back. It might just keep going up. But we don't want to buy a whole bunch of shares. We just want to take advantage of the market if it falls back down a little bit, right? Markets have done that in the past. They have a tendency to go through wave patterns, and so we're going to anticipate at some point this thing's going to wave. Now, is today the best day to decide to do that? You never know. Right? We never know what the market's going to do. So we can only make our very best guess, or our swag, our scientific wild ass guess. And that's what we're going to swag this thing at. We're going to swag that eventually this market's right in here somewhere, probably when those blue lights intercept, right up in here somewhere, this market's going to turn and fall. So we want to buy an option. So we're going to buy a put option. So I'm going to come down here in the window. And if we think a market's going to fall, we want to buy a put option. Now, we don't want to get crazy because it could continue to rally. So we're going to come in here. And we want a little bit of time. How much time do we need? Well, let's do a little time value in here. We're going to come in and we're going to say, well, this market has a tendency to move through time like this. If that becomes the peak, let's say the peak's right up in here. Let's imagine right in here somewhere. Probably by about January 1st, if it does turn and start to fall back down and just comes down that scale just like it did before, right? That's what that ABC is. It just tells us, well, if it does the same thing it did here, on the downside, it would come back and be back in this region, this Fibonacci sweet spot, sometime at around December 26th. So the end of the year. So how far out is that? That's 30, 60, 30, 40 days, 50 days. Let's see, we even got a calculator. Come in here and draw it out there. Let's say if it comes back at that point there, that's 40 actual days, 29 trading days. So we need to have at least 40 days in our option. And I always like to go about 30 days more, because we know that time decay decays very fast towards the end. So if we go 30 days more, we want to give ourselves 30 days so we don't have to worry about that time decay as much. And we're going to go out 71 days. So we're going to come down here. We're going to go down 71. We don't have a 71. We have a 59. That's not long enough. 87, a little bit better. Let's go with the 87 days. That's how you decide how long you need. All right. That's just a quick little calculation to show you how you pick the amount of time you need to put onto your option. So that's how much time we're buying. So now we come out here and our put option is $2,817 at the money. Okay, so it's at the money. So now that's one thing we can do. We can buy an at the money put option, which would be right here at the money. And if the market falls from that point down, we would make money as the market falls, right? Based on delta. So let's come in and think about this. So that's $2,815, but we don't need to buy that much. We could buy less because we could have less delta. But the point that I want to make to you is look at the theoretical value. That is your Black and Scholes column. Okay, can you see that? So that you got your premium and you got your theoretical value. The theoretical value is the Kelly Blue Book for that option. Okay. The option, if you look it up in the Kelly Blue Book, that option is worth $3,000, $3,187. And we can buy that option for $2,812. Now, can you see why that number is important? Now, can you see why Black and Scholes got a Nobel Memorial Peace Prize? Not peace, because they weren't saving wartime. Can you see why they got such a big award? Can you see why that's important? Can you see why you don't want to trade options if you don't have that number? That option is worth $3,176, but you can buy it for $2,810. Now you have to ask the question, how come is it trading for less money than it's worth? Why can I buy that option for less than it's worth? So when you go onto a car lot, a used car lot, and the dealer comes out or the salesman comes out and he's like, hey, you can buy that car for $12,000. And you're like, wait a second. I just looked in the Kelley Blue Book. It said that thing's only worth $10,000. How come you're trying to sell it to me for more than what it's worth? Oh, well, it's got special wheels. It's got special radio and stereo system installed. They put a sunroof on it. They jacked it up. They put a big chromy thing on the engine. They got these side rails. They've really beefed this little car up, right? So it's worth more money. So then you have to justify the additional expense. But what if it's the other way? What if you go on and you look at the Kelley Blue Book and it says, this car is worth $10,000. And the salesman says, we're selling that car for $8,000. And you're like, wait a second. Why are you selling it for $2,000 less than what the Kelley Blue Book says it's worth? Oh, well, it doesn't have all those things that's in there. And what you discover is, hey, there's probably something wrong with that car, right? Somebody probably put some sawdust in the transmission so they could get it to the lot, It's probably got something that you don't know about. If they're trying to sell it for less than what it's worth, you got to start asking yourself, what's wrong with this? What's wrong with this car? I don't trust these guys. Why are they selling it for less than what it's worth? Well, you got that same situation right here when you're looking at the theoretical value of an option. Then they're saying, hey, this thing is worth $3,217, and you can buy it for $2,817. Hey, wait a second. How come are they selling me an option for less than what it's worth? Well, that means that they don't believe that the market's going to fall. That's what it means, right? So that means you can buy it for a bargain. But I can promise you, experience tells me that if that market falls one price bar and creates a lower low, that price of that premium will go above the theoretical value. As soon as that thing shows weakness, like it's going to start to drop, that option premium is going to shoot through the roof, and then it's going to be more expensive than the theoretical value. Okay, and that's how you make money in these options. If you wait for the market to drop, you're too late. You've lost that implied volatility. All right, the implied volatility right now to the downside is very low. Why? Because the market's trucking up like a rocket ship. Nobody thinks it's going to go down. So they're going to sell you a put option, which says you only make money when the market falls, for a very discounted price. You're going to get a good price on it. Can you see how important that theoretical value is? If you don't have it, don't trade options. Simple. If you don't have the Black and Scholes theoretical model, do not trade options, because you don't know if you're buying it for a bargain or you're getting it for a discount, or if you're paying a premium for it. Because without that number, you're just shooting in the dark. Okay, right now, I mean, you can derive it. You can say, well, the market's going up. I'm paying $2,845 for a put option. It's probably less money than, the theoretical value. I'm probably getting it for a bargain because the market's going in the opposite direction. You could think that in your brain, but don't you want to know the number? I want to know the number. How much discount? Am I getting it for a big bargain? Am I paying a way premium for it? What am I paying for it? So now we can come in here. I'm going to show you a couple really cool things. We could come in here and we just say, I'm going to buy a put. I'm going to buy the put. Now, if I buy it at the money, remember, at the money, it's got a delta of, what's the delta? 0.44. All right. Can you see that over there? 0.44 on the delta. So that means it's going to make or lose 44 cents for every dollar that the underlying stock moves. So it's like buying, in this case, shorting the market, right? Making money as the market falls, 44 shares. So it's like shorting 44 shares at this point. So that's what that is doing, 44 shares. Now, if we bring the put option down out of the money, let's say down here to 38.2, then that one doesn't cost us nearly as much money. It only costs us $1,370. $1,370 as opposed to $2,845. But the delta on it, let's set that in there so we can see where it's at on the screen. The delta on that thing is 24. Okay, so you see down there in the window, it's 24. So the delta on that one that I just dropped on the screen is a delta of 24, meaning it's going to make or lose the same amount of money as if I had 24 shares or 24 cents on the dollar. Okay, but I don't have to pay as much for it. It's $1,352. Now remember, in our example before in the Apple model where we just bought a whole bunch of options, one deep in the money, one at the money, one out of the money, one deep out of the money. Remember those 4 options? The one that was out of the money actually paid a higher return, didn't it? Because we're taking a bigger risk that we won't get our 1352 by expiration, that the market will be above that green line by expiration. Now we got a cost of doing business too, 1352.50. So we have to take that into consideration. Add expiration. But if we're not worried about expiration, we're not actually expecting this market hanging on to this option all the way to expiration, are we? Because we bought that extra 30 days of time so that we didn't have time decay that's going to kill us, because time drops off much more quickly at the end than it does at the beginning. So we're not planning on holding this all the way to the purple line. We only want to hold it until it comes back and tests that Fibonacci sweet spot. And so we can hold or have an option that we anticipate is going to fall back to the Fibonacci sweet spot as this thing bounces off this top and people start to take profits. So that's our idea, right? Our theory is that this market is going to top out up here, and we want to be ready for that with a put option to make money as the market falls. You'll notice that the chalk and money flow has started to reverse. We have a high point right here on the chalk and money flow. We have a lower point here on the chalk and money flow, and we have a lower chalk and money flow right there. This is all bearish, all right? This is called divergence. Remember, we talked about convergence and divergence. So divergence is that this is showing divergence. So we're getting lower highs on the indicator and higher highs in the market. If we turn on stochastics, we're probably going to get a stochastics pop though on this one. So let's stochastics. Yeah, it's up there popping. So we're not going to take that into consideration. Stochastics is based on a 0 to 100 scale. Now, we haven't talked about indicators and talked about the scaling and how these different indicators work one with the other in great detail. We did that a little bit in class at the university. We haven't done that much here in this class, but the indicators work on different scales, and so it's important for us to understand that. That's why you can have a stochastics pop, because it's on a 0 to 100 scale. Once it gets to the top of the scale, it can't go any higher. All right. So you have to take that into consideration. We'll talk about that in another class. So we're going to go ahead. We're going to just for classroom sakes, we're going to come in and we're going to buy some put options. All right. So we're going to buy a put option. We're going to go ahead and we're just going to let's actually buy a couple. Should we, just for examples? Hope we have enough money. We should have plenty of money. All right. So we're going to come in here. We're going to buy that one. We're going to buy a put. We're going to buy another put. We're going to buy one at the money. All right. We're going to do another example on this market. We're going to buy another put. We're going to buy a put out of them or in the money. That would be an expensive put. We got plenty right here. We got this one at the money. Let's put another one in far out of the money. So we're going to buy a put. We're going to put one down here at 61.8. All right. So $657. So we're going to buy 3 put options. Again, this is just a model that we're building so that we can see what happens. See what happens. We'll see what happens if the market runs. If the market keeps going up, which it very well could, right? If the market keeps going up, we're going to watch and see what happens to these put options. See how badly they die. All right. So if we look at the theoretical value, now look at this one here. The theoretical value for that option, this one here, the 435 put, the one in the center, that 435 put, that thing, the theoretical value is $1,600, and we're getting it for $1,300. So as soon as that market shows weakness and starts to come down, that thing's going to pop back to $1,600. We're going to make $300 in that fast because it's going to go to $1,600, which is the theoretical value, the value of the market. As soon as it shows that the market's going to drop, that thing's going to go from 1362 to 1662 that fast. All right. And same down here with the one that's down here. 793 is the theoretical value. We're buying it for 652. And the reason we're buying it for 652 is because we got a discount on it. Went onto the to the car lot and there's something wrong with that car. Well, what's wrong with this option? Well, the market's going up. That's what's wrong with this option. So that's why it's discounted. But as soon as that market turns and starts to come down, bam, that price is going to go right back to the theoretical value and might even go more expensive, right? So as soon as it shows weakness. So that's why we buy it in anticipation of the turn. We get a better price on the premium of the option. It's so important to know. And so now the theoretical value of the one we're buying at the money, 3,248, we're getting it for 2,800. So we're really buying these things at a bargain. Again, though, the reason we're buying them at a bargain is because the market's going in the wrong direction from our option. Okay. And so that's called market sentiment. And so we use that as a sentiment indicator. And you don't have to just use it. You don't have to just use it with options buying. You can use it when you're day trading, even, for example, or when you're going to buy some stocks or buy some shares of a stock. You can come in here and say, well, I'm not buying options. What do I need the Black and Scholes for? No, that's the whole idea. The Black and Scholes is a sentiment indicator of what the market believes. All right. And it's not just a guess. It's not just somebody calling you up on the phone and say, hey, do you think the market's going to go up or down? It's actual people putting their money where their mouth is. They're actually spending and buying these options, and they're either buying them for a discount or they're buying them for a premium. They believe the market's going to go up. They believe the market's going to go down. And you can use this extremely valuable information to help you make your trading decisions. Are we bullish on the day? Are we bearish on the day? The market is bullish on the day right now. You can tell because the premiums to the put options, that means the market's going down, are really discounted. That means they don't believe the market's going to fall. The minute it shows that the market's going to fall and it shows some weakness, those put options will shoot right back to the theoretical value. Okay. So we're going to go ahead and I'm just going to mark it into these because we are in the demo account. We're going to place those and we add all three of those in there. And now we got our three put options to the downside and we're going to just watch them. One's at 38.2, one's at 61.8, and one's right at the money. And we're just going to see how those go in relationship to the theoretical value and to our profits, our percentages. And we're going to watch the deltas because the delta at the money is 45. The delta of the far out of the money is 25. And the delta of the 400, the way out of the money, is only 13. Okay. So if this market falls, we'll make money. If the market doesn't, if it continues to truck higher, we'll lose money. And we're going to watch that too, because I want to teach you about convexity. So convexity is tomorrow. We're going to learn about convexity. All right. So don't miss tomorrow's class if you want to learn about options convexity. All right. Let's jump into our Sunday school lesson. Oh, before we go to the Sunday school lesson, let's go over and look at the futures market, at our day trading market. See what's going on over here. Oh, look at the S&P. Crushed it to the downside. Come flying back out. Oh, look at the little Russell down here. Russell. Oh, so we took that, tried to get that long position as it went up. We were pushing it up towards the blue. It failed. Had this fall back. Now it's going to try again. It's trying again. So we got a push right here. I think that was a push. And then it continued to rally a little bit. We got an accumulation stage in here where they started picking up some more. It actually looks more like an accumulation to the upside, doesn't it? That's just ugly in there. Too many topping tails and bottoming tails. But now it's starting to go flat bottom. It's going to try and go up and touch that blue line again. All right. Over here on the NASDAQ, we're rallying on the NASDAQ. NASDAQ's starting to look like we want to get a retracement in here. Throw in your Fibonacci ruler. Back to the 50%. Maybe back into this area here somewhere. Same thing up here on the S&P. Problem is that we've got the red arrow saying down, right? Red arrow saying down. Your yellow arrow saying no, no, no. So this could be an overall longer term 1, 2, 3. We'll have to see what happens here where that new red arrow comes in and get an additional downside push out of here. All right, Sunday school lesson. Let's go back to our Sunday school lesson. All right, plan your trade and trade your plan. Don't fall in love with your trade. All right, don't fall in love with your trade. Perfect your exit strategy, and remember, the only way to bank a profit is to exit the trade. Oftentimes people stay into a trade too long because they love it so much. They fall in love with it. Oh, I love Apple. I have my little Apple iPhone. It's so beautiful and wonderful, and I just love my Apple iPhone. So I'm long Apple stock, and I just love Apple stock, and so I'm going to keep it forever. Never going to get out of it. And then they lose a whole bunch of money because it turns and it falls, because it hit the third drive of an Elliott wave or whatever mathematical model that occurred. Oh, but I don't believe the mathematical model because I love my iPhone, and so I love Apple stock. Don't fall in love with your stocks. Promise. You can buy them again later. Take your profits, plan your trade your plan, take your profits, get in, get out, do the right thing. Don't fall in love with your trade, okay? Don't fall in love with it. It blinds you, all right? Falling in love with your stock. Oh, I'm not going to trade your stock, Land, because I love my stock. My stock's not doing an Elliott wave pattern, so I guess I can't trade, or I'm going to trade it anyway. See how falling in love with a stock or falling in love with a position? See, I fall in love with the Dow sometimes because I've had so much good luck with the Dow. I ignore the little Russell down there in the corner who's trending beautifully because I want to go to my love. I love the Dow, and I end up losing on the Dow because I love it, and it's not treating me well today. It's like a bad girlfriend, all right? So dump that thing and go find your new girlfriend down there with the Russell. Fall in love with the Russell for a little while. All right, guys, don't fall in love with your trades. That's my class for today. It's my Sunday school lesson. And we're headed into the holiday weekend, and I'm looking forward to Thanksgiving. You guys have any questions, please let me know. And if you would like to get together and talk to me one-on-one, you know how to do that. landturner.setmore.com is my online calendar. Be happy to help you guys set up your software if that's what you'd like, or talk about your financial goals if that's what you would like. I'm here for you. And for those university students who are on break right now, we've got next class coming up after Thanksgiving, and it's going to be tools for the trade. And we're going to have a lot of fun in that class. It's a really fun class. Not that all the other classes aren't fun. We have fun in all of our classes, but that's a especially fun class. So hopefully you can make that. And for you guys who are not able to make it, we'll follow up with that here on YouTube, and you guys can come and join in and enjoy the labs. All right, take care, and we will see you tomorrow morning, 7:25. If you want to give me a thumbs up, I'd appreciate it. That would be good. I would love to have a thumbs up from you guys. We'll see you tomorrow.